How can South Africans go about protecting their financial future? Well, one option is to explore offshoring their investments. Magnus Heystek is a well-known advocate of this approach. He's with Brenthurst Wealth Management. Magnus, welcome to Solutions with David Ansara. Could you tell our viewers what are some of the benefits of going offshore?
David, good afternoon. And, I haven't always been such a strong advocate of offshore investing. Many years ago, I told people after, or even prior to 94, I said, now's a good time to put money into the country. I was very bullish at that time. And I can only speak to the facts. And for a very long time, there was no need for South Africans to consider offshore investing. The South African stock market, property market, bond market did extremely well from about 95 up to about 2007. We were one of the better performing stock markets in the world. So it wasn't a real issue for South Africans. They were making enough money. We had a major commodity boom. Our platinum mines, our gold mines, our coal mines, iron ore, etc., gave fantastic returns. In fact, money was flowing into the country. The rand strengthened to R5.50 at one stage. So, to tell people to take money offshore while the country was booming would have been counterproductive, and it wasn't necessary. However, from about 2010, 2011 onwards, I started seeing some signs in my tea leaves that started alerting me to consider some offshore diversification. And firstly, it was mostly dependent on what was happening in Wall Street and also in Silicon Valley. There was some tremendously exciting stuff happening in the United States. The technology boom started taking off, the biotechnology, and you could not avoid putting some money into that sector. We didn't have a technology sector. And the only way to get access to those very innovative sectors was, of course, to take some money offshore and put it into Amazon, Apple, Netflix, and et cetera, et cetera. So in the early stages of my so-called offshore recommendation, it was purely diversification and getting to be part of that very exciting stuff happening. Now, from about 2015, it became a bit more ominous, and there were some political factors starting to creep its way into my analysis and my forecast, especially after former President Zuma firing Nhlanhla Nene as finance minister, the 4-day special finance minister, and then the reappointment of Pravin Gordhan. I mean, that was a disaster as far as the foreign investors were concerned. And combined with a lot of negative stuff happening, one had to start saying to people, the numbers have changed, the fundamentals have changed, the macroeconomic picture looking poor. Get some money elsewhere to work for you to protect your global wealth. And that has been the case for the last 6 years. And fortunately for a lot of people who took that advice, they've managed to build offshore assets that are unprotected or uncorrelated to the South African market.
So Magnus, that's the stock market, but what about the property market? I saw a recent article by you on Biz News talking about the R1 trillion property collapse. Was that just a clickbait headline, or is there some substance to that?
Not at all. I mean, at the same time, we're talking about the whole macroeconomic picture of South Africa was deteriorating very, very rapidly. Our GDP per capita was dropping, and consistently we started seeing that South Africa in international terms was getting poor. So you had the stock market, which was the more immediate impact. People, foreign investors, started taking their money out of the market, either the stock market or the bond market. But from about 2017, 2018, and even prior to that, we saw that the residential property market was moving sideways in rand terms, and in dollar terms, most definitely downwards. So if you look at the residential property market, it hasn't recovered to this day to the levels of 2007, 2008. So there was a nominal decline, and in real terms, a decline of about 25%. Added to that, if you look at the listed property sector, which had a tremendous run from about 2011 to 2016, around about that time, the market peaked. I mean, everybody was just making money hand over fist in our property market. I'm talking about our listed property market. But since then, due to oversupply, the increase in rates and taxes, the pressure on consumption expenditure, and a whole host of other factors, the returns of the listed property sector has been about 50 to 60%, in some cases 90%. And if you put a number to it, and you do the numbers whichever way you want to do it, you get very close to R1 trillion in losses, directly or indirectly, for owners of those property assets. I used in my article an example of one of the Liberty Life property funds that owns very prestigious shopping centers like Sandton City and Eastgate. And if you look at their fund fact sheets today, the valuations are down 50%. I mean, investors have lost 50% of what they were worth at the beginning of 2016, 2017. So not clickbait, that is what it has cost South African investors in rands and cents in the local property market. And I'm not even talking about the stock market. This is just pure bricks and mortar. And some of those listed entities today are worth 10 cents what they were worth 5 years ago. That is a humongous loss to owners of those assets.
Now, Magnus, what about the importance of diversification itself in terms of the principle of it? I think intuitively it makes sense to not have this concentration risk in South Africa, especially given all of the political and social headwinds that the country has experienced, particularly over the last month or so with the riots and looting in Natal. Why is it important to branch out into other markets and to spread your asset base?
Well, the old age investment principle, don't have all your eggs in one basket. And we have some cases, and I'm aware of some cases of people who were shopping center developers, and they only had shopping centers in KwaZulu-Natal, and they had their personal property in Natal, and they had maybe a beach house at Zimbabwe or wherever on the coastline. Now, that asset class of that individual or family or whatever it is has been affected very, very substantially, both in the real terms, if they were damaged, and also in the perception of what the real value is of those assets. That's just a prime example. And the same applies to South African investors who primarily have a listed instrument on the JSE via their pension fund, which, by the way, as I've written many, many times, has been one of the worst major stock markets in the world over the last 10 years. And in fact, in dollar terms, the JSE has grown by maybe 2% over that period of time. So it's shown no growth in dollar terms. Over 5 years, over 8 years, you've made no real money in rand terms in certain sectors. So, and in the meantime, the world has been experiencing a tremendous stock market boom and also a property market boom. And on a relative basis, it becomes an issue. You should try and protect your wealth on a global basis. And unfortunately, some of those predictions have come true in the sense that people have lost money in terms of the currency. They've lost money in terms of no growth on the stock market or pension fund. And now their property values are also being discounted between 50 and 90%. And we have figures now starting to come through from independent research companies like even the University of Cape Town, saying that half the middle class in South Africa has been wiped out. And now that should be a headline on most front pages of newspapers, but it's not. It's like the mainstream media wants to ignore it, but it has profound implications in terms of wealth creation, the ability to pay taxes, the ability to collect taxes, and what goes along with an affluent and prosperous middle class. So when independent researchers say half of the South African middle class has evaporated, people need to take notice.
Yeah, and that has important consequences for those people who may have been on the margins of the middle class and now they're struggling to make ends meet. And also in terms of intergenerational wealth, that's going to set back subsequent generations as well. Magnus, you mentioned the rand, and I've been surprised by how robust the rand has been over the last year or so. That's been driven by the commodities boom, our balance of trade. We have a very significant surplus, mostly fueled by exports of minerals. Do you think that the rand is at real value at the moment, at fair value? Do you think that we're likely to see a weakening over the medium to long term? What is your view on the rand?
The rand has been the beneficiary of a very weak dollar. One has to acknowledge that the dollar has been very weak, driven by the policy of quantitative easing, the Federal Reserve cutting its interest rates almost to zero, bond yields down to 1% and below 1%. That has been driving the rand stronger and a lot of people think, look at the rand, it's strong. It's not the rand that's strong. It's the dollar that has been weak. The last 6 months or even 8 months, we have benefited from a very, very strong commodity cycle, totally unforeseen as a consequence of the global pandemic. And that has boosted our balance of payments quite tremendously. Platinum taxes have been, revenues have been astounding, but these things tend to be very cyclical. They don't normally last long. And the fault the government is doing now is trying to commit to long-term expenses on the back of a boom that normally is very short-term of nature, which creates a funding deficit a year or three down the line. So to answer your question in a roundabout way, at Brenthurst, we think it's a superb time to be buying dollar-based assets, because if and when the US Federal Reserve starts increasing its interest rates, which they've said they're going to do gradually over a period of 3 to 4 years, the dollar probably will strengthen and it will lead to an outflow of money from the emerging markets, of which we are one, and we're already sitting with very high debt levels, and we have massive debts in South Africa. So we could pay the price for this windfall that we're experiencing now, as great as it is, but we're spending it on long-term commitments, which we might not have the funding for 2 or 3 years down the line.
Yeah, and a lot of that stimulus money is going into infrastructure development in the developed world. And so that's driving up some of those commodity prices because that's increasing demand for raw materials.
Yeah.
And you mentioned also the current environment globally, where there are very low interest rates, very high levels of quantitative easing, which is artificially pumping money into the system. And so investors are seeking yield in other parts of the world, like South Africa, even though it has very well-known risks, there's still some return on investment. So that could turn very quickly, and you could see an exodus from emerging markets. But now, if you're a South African investor and you're wanting to get into maybe a developed market, surely the stimulus that has driven the growth of those stock markets, that's going to come to an end at some point as well. So, in terms of the timing of one's investment, is that not a poor time to be getting into the market when it's very high and very inflated?
Probably would be problematic in terms of timing. You never get the timing right. In fact, you have to get timing right twice. First of all, exiting South Africa for whatever reason, and secondly, entering whichever market you choose to go and invest. Now, the offshore-onshore conundrum is not necessarily purely developing markets versus emerging markets. Sometimes there are other strategies to consider with your money that has been taken abroad, because you're never going to get it right. We have it from our clients daily. They want to buy the rand at the cheapest possible level, and they want to buy into the offshore market also at the cheapest possible level and get it right both times. It's not going to happen. We tell them that, and we're quite honest when we tell them that. Once you've externalized your rands or you reduced your dollar rand risk, you need to then consider your dollar stroke euro, stroke pound, stroke yen risk. That's an entirely different game, and you need different strategies once you have the money offshore. So it's not always actually, automatically sell the rand and buy the dollar. It could be the euro. The euro is looking quite strong. It could be the pound. It could be the Japanese yen. It depends on objectives, and depending on to what levels global interest rates go up to. There are other ways of protecting your capital by using guaranteed products, which will give you a dollar guarantee, which we use quite extensively in our portfolios. But thinking you're going to get it right and have a risk-free ride, that's not going to happen, David.
All right, and maybe we could turn the conversation to pensions, Magnus. And we have a retirement annuity structure where you get a tax advantage from contributing to that. How have RAs and other pension funds performed over the last 10 years or so? Do you think an RA is a worthwhile investment given that short-term benefit that you accrue in terms of the taxation?
Up to 10 years ago, the investor could have chosen his own allocation in terms of retirement annuities and preservation funds, provident funds, etc. And in 2011, government stroke treasury stroke the asset management industry introduced the regulation 28, which limited the offshore component across the board to 30% and then 10% in Africa, but I'm excluding that as an offshore investment. It's not an offshore investment, in my opinion. So you effectively could only access offshore markets with 30% of your investment amount. So that was bad timing from the government and treasuries, because that coincided with that 10-year period of terrible underperformance by the South African Stock Exchange relative to world markets. And as a consequence, most pension funds, and I do these numbers for a living, over the last 8 years have not beaten the inflation rate in South Africa, another headline, or which should be a headline, and over 10 years, barely beating inflation by 1 or 2%. So again, a reason for the middle class being decimated is that their pension funds have not beaten inflation over 8 years, and that's a statistical fact. And in my opinion, direct consequence of Regulation 28. So to answer your question, over the last 10 years, an RA or a preservation fund or anything linked to Regulation 28 has been a dreadful investment. It's been a terrible one. In most cases, people don't have a choice. You have a one-size-fits-all pension fund approach. The Henry Ford approach, you can have any car you want as long as it's black. And here we have a situation where people of 25 have to have the same asset allocation, risk profile, etc., as someone who's 65, which is crazy, it's stupid. And to answer your question from an entirely financial perspective, I'm not in favor of retirement annuities for people under the age of 55. And why I say 55 is a technical reason. After 55, you can put money into an RA, get the tax relief, and immediately convert it into a living annuity that can give you 100% offshore exposure. But for young people, I would tend avoiding, I say don't put money into an RA, put it into a tax-free savings account, put it into a discretionary account. I'm not a great proponent of retirement annuities for young people. The big asset managers love the product because you tie up someone's money for 30 years. That's a wonderful product. They can't pull it out, or it's very difficult. But from an investment perspective, statistically, the last 10 years has been a disaster. It's been terribly, terribly poor. But the mainstream media doesn't want to talk about it. Radio stations who are heavily sponsored by the big asset managers don't want to touch the subject. And I've tried. I've sent stuff to probably every mainstream media in the country, radio station. And I'm saying, guys, here's a crisis. Discuss it. And guess who are their sponsors? The big asset managers. So it won't become mainstream news unless channels like yourself and others start really shining the light on this developing crisis.
And Magnus, there are many political risks which are well known to our audience. That includes the ongoing debate around prescribed assets. That's currently off the table officially, but it's been on the table, off the table, back on the table again since the Nasrec conference in December 2017, when it was adopted as a formal position of the African National Congress. So do you see Regulation 28 and potential amendments there as being asset prescription through the back door? Is there a risk to that 4 trillion rands worth of privately held pension funds in South Africa? Do you think that that risk is overstated or not?
No, I don't think so. I think, as you say, it might seem that the risk is off the table, but I think they've done a backroom a deal with the asset managers. I'm talking about government now, saying, okay, we won't go for full on prescribed assets, but we would like some unwritten agreement that you will support our infrastructural drive and put between 20 and 40% of the assets that you manage into infrastructure, which seems to have calmed things down, but there are certain people who are very worried about it. The lack of detail. I mean, infrastructure. What is infrastructure? How do you invest in infrastructure with a pension fund? I mean, how do you measure it? How do you manage it? How do you derive an income out of it? So there's lots of people very concerned about this. And it will, if it carries on, it won't solve the problem of lack of growth in the SA economy and the lack of returns. So this topic will not go away. In fact, it might come back in the future.
And Magnus, earlier you were speaking about international exposure, and many people might counter your argument and say, well, look, many of these JSE listed firms already have international footprints. If you think of Naspers, for example, that has a big holding of Tencent. Then the counter to that is, well, then you're subject to the whims of the Communist Party of China, who are currently engaged in a war against tech companies and other entrepreneurs. So, I mean, I guess the point I'm trying to make is, South Africa is a bit of an unstable place, but the world is also pretty volatile as well. So what would you say to those commentators who say, well, the JSE is already pretty internationalized as it is?
Well, first of all, if that is the case, well, then there's no argument in me recommending people take their money offshore. Because if you are advocating international investment, international companies, then I might as well go full hog and take the money offshore and do it cheaper and more tax advantageous with my money offshore. So that argument doesn't hold. So that's the first point. Because it's been only, the last 10 years, it's been primarily the international earning companies on the JSE that have actually dragged the JSE up. If you can look at everything else, the domestic sectors, I mean, retail, property, banking, they've been a terrible drag on our performance. So it's been the offshore component, which I'm advocating, has kept the JSE going up to a certain point. The second issue is, and there are a couple of issues, because a lot of the truth gets twisted by people with vested interest, is that, I've been accused of being disloyalty and it's anti-South Africa and I'm chasing money out of the country. Those foreign listed companies that are listed in the JSE don't pay taxes in South Africa. In some cases, they don't employ anybody in South Africa. Our asset management companies, by and large, our largest one, are either wholly owned by offshore companies or predominantly by offshore companies. I'm talking about Allan Gray as an offshore company, Prudential, owned by the Brits. 91 is listed in London, Old Mutual was listed. So, you're sitting here with our asset management industry is predominantly owned by foreigners, and now you tell people don't invest money offshore. And there's just too much vested interest that pops out, because our fee margins on our very, very large retirement pots are just about double the average in the world. And the people in London and New York tell me we've got the biggest margins on money in the world, just about. And that's why they're so anti-take money offshore, because once you take the money offshore, it goes into funds and goes into structures that are much, much cheaper than the local one. So you always have to remember that when people say that. And the last thing is, if you look at the JSE itself, In 2000, the JSE had 602 listed companies. Today, 20 years later, it's got 320 listed companies, of which about 15 are suspended and about 5 have indicated that they are going to delist. And there's a number of rumors about other companies looking at delisting or being bought out, which will pull that number down to below 300. So the JSE has lost half of its listable companies. Over the same period of time, I'm talking about the last 5 years, foreign investors have pulled, and I do the numbers every month, they have pulled 650 billion rands from the JSE. They've been disinvesting every month consistently for the last 6 years. There's a brief uptick around the 2017 December ANC elective conference. There was a bit of inflow of money on the back of Ramaphosa. That lasted about 4 months, and then it collapsed again. So the net outflow from our equity market, 650, and from the bond market, it's about 140 billion. So the foreigners do not like what they're seeing in South Africa. So how can you tell the South Africans to bait fuss and alles sal regkom when the foreigners are not sticking around and they are investing in other places of the world and becoming wealthy? We are not. We're becoming poor.
Magnus, last week on the podcast, we had Frans Cronje talking about how to develop a plan B and to be realistic and frank about some of the risks and the challenges. And even if you do want to live in South Africa, there's strong merit, as you've argued today, about having at least a portion of your assets offshore. So what are the practical steps? How do you actually go about realizing this strategy? And as Frans said, diversifying your income sources, where you live, but also your asset base is really important. So how do you go about setting about a plan in terms of securing your financial future as an individual, as a normal middle-class person, for example, in South Africa?
I think middle class and even upper class South Africa has been doing that in one way or the other in many different ways. One way has been to send your kids to very good universities in South Africa in order to get international degrees, medicine, engineering, accounting, actuarial sciences, always on the basis, Yanni or Sunny, you can go and do this anywhere in the world. And by and large, that's been true. If you look at the class reunion of the Wits Medical School 1990, you'll probably find half of them have left the country. So that's been a long-term trend for various reasons. Secondly, I think a lot of people have started sending money offshore to create offshore portfolios just to diversify, but also to create a nest egg. And it's always been the kind of preserve of the very wealthy, offshore, you must be extremely wealthy, but that's not the case. In the last 5 years, as I said, for political reasons, we've externalized a lot of money successfully for our clients, setting up structures fairly cost effectively in various jurisdictions in the world, Mauritius, Guernsey, Isle of Man, totally legal. And today people thank us that they have 20 or 30 or 50% of the assets somewhere not affected by South Africa and possibly not affected by future events in South Africa, in the sense that government might want to clamp down on the flow of money or exercise more control, like they already are with retirement annuities and pension funds when you immigrate. So it's quite doable. A lot of people have done that. But I think a lot of people have been soothed by the mainstream media, and particularly the Afrikaans media, for some reason, have been very anti-offshore investing, and that it's a terrible thing, and you're disloyal and unpatriotic, which I really don't understand. And I think they've misled their readership into thinking that everything is fine, and now it's not fine. People are sitting with properties they can't sell or portfolios that have not performed for 10 years. I mean, it's quite astounding how they've managed to twist the narrative. And people are now waking up for the first time. Now, I've been listening to Frans Cronje for a long time. He's been a speaker at some of my seminars, and I've seen his positioning in terms of this plan B evolving over time from 5 years ago to now. He was fairly conservative, and now he's gone radical, full on, saying every South African with the means should create a plan B, because we don't know what's going to happen, and more importantly, how government is going to react to this. And the reason why I mention this, David, is one must not forget foreign exchange regulations are still in place. You don't have to go to the parliament to change any law and get buy-in from the public and have debates in parliament about it. It's an existing law which has just been amended to allow people to take money offshore. It can be changed overnight. Now that, to me, is not a great position to be in. And from my personal perspective, my liquid assets are not in this country, because I think within the next 2 to 3 years, we can have full-blown exchange controls back again, and then there's nothing you can do about it. Then it's too late. Let me just say that again. I'm saying that don't be surprised if government, if there's a run on the currency at some point, just announces the introduction of exchange controls. It's not a new law. They can just do it overnight, and the gates are closed. They've already given those signals. They've tightened up on people who are immigrating or who have immigrating. You now have to leave your money here in South Africa for 3 years. That can be changed to 5 years. That can be changed to 10 years. So that, to me, is a sign that government is aware of the outflows. And if you haven't taken some money offshore, you may just end up paying the price for having your money all in one country, which is not smart.
Yeah, and that would take us back to the days of the late apartheid era, where the fortress walls were raised and South Africa was isolating itself from the rest of the world. It's not inconceivable that we could go back to that. Magnus, what is your view of the South African Reserve Bank? In my view, it's quite a well-run institution. It's been able to push back against political pressures to loosen interest rates, and is run in a fairly technocratic way. Do you think that that institution could be subject to some kind of regulatory capture as well, in the way that we've seen with other institutions in South Africa?
I have to agree with you mostly that the Reserve Bank has been one kind of bulwark against this government trying to take control of everything financial. And I think that's a very good point, that the Reserve Bank is still independent in many respects, hasn't succumbed to this modern monetary theory thinking which has become very prevalent, that the government should reduce interest rates and print more money and we can spend ourselves out of the trouble. But remember, it still will take its instructions from government. It says money cannot leave this country. That is not a Reserve Bank decision. That is a Treasury decision at the end of the day, and that is controlled by the ANC. So don't bank on the so-called independence of the Reserve Bank, because we had that under the previous regime. Government just announced 1961, that's it, we have exchange controls. And for 38 years, it was a terrible crime to take even 100 Rand without permission, and all that goes with it. It's bad for trade, it's bad for international finance, it's bad for everything. Currency takes a pounding, and you have that fortress economy as you're talking about. So do not exclude that. I mean, things have changed. The unrest in KwaZulu-Natal have changed all the parameters and calculations and forecasts. When someone like Kemp Santa suddenly says it's now a 50-50 chance that South Africa will become a failed state, that was up from about 10 to 15% just a couple of years ago. And people like Frans Cronje and others were saying the situation is very, very fragile. And if it does start collapsing in parts, which it already has, don't think that the government is just going to allow the capital gates to remain open and that money can flow out of the country. That's not going to happen. And if you think it's going to be a permanent situation, I don't believe so. And I've been advising my clients for a very, very long time, and they've taken advantage of that.
Magnus, in an earlier episode of the Solutions Podcast, we had Rob Price talking to us about sound money, and he's a big advocate of cryptocurrencies. What is your view on cryptocurrencies as an alternative store of value or as part of a diverse portfolio? Do you think that that's just hype, or is there some kind of benefit to having a portion of your portfolio in cryptocurrencies?
You have to understand that cryptocurrency is still an unregulated asset class or currency in South Africa. And from a legal perspective, I may not and will not give a comment on whether to invest in cryptocurrency or not. We are tightly regulated. And if something happens and someone listens to this podcast and goes and buys Bitcoin because I said so, I can be held responsible for. I'm saying no. I'm not commenting on Bitcoin. I'm not saying you should buy or sell. No comment. My general comment is that there's too much unexplained things within the cryptocurrency world that I cannot get an answer to. The more I try, and I've tried hard, and I read and I speak to people, just to cut a very, very long story short, I will not invest my own money in cryptocurrency. Based on what I know now, I think there are much easier ways to hedge your risks by means of other investment instruments that there are. I might be wrong, but I'm quite happy to be wrong, because I cannot honestly one day stand in front of a black-robed judge and he says to me, Mr. Heystek, how does cryptocurrency actually work? And I can't draw up a simple picture, and I'm not going to take that chance. So the answer is, I don't think so, and I don't know.
Magnus, as we draw this discussion to a close, do you have any kind of last words of advice for South African investors who might be concerned with the trajectory of their investments in the country? What is the advice that you would give to them as a kind of a first step?
First of all, I want to make it very, very clear that I'm not anti-South African or anti-anything. I live in this country. My kids are here. My grandkids are here. But my investments, or the investments of anybody who has taken money offshore the last 10 to 15 years, has protected their lifestyle in South Africa and has enabled them to build fortresses around their family bond, in terms of maybe living in a better area or a different part of the country in a safe environment, as opposed to having not made those foreign investments. Because let me assure you, the difference in returns have been substantial, local versus offshore. And having money offshore gives me optionality, which having all your eggs in one basket in South Africa does not give you. So remember the word optionality. I talk about it a lot. It just gives me optionality that you don't have if you don't have money offshore.
Magnus Heystek, thank you very much for joining me on Solutions with David Ansara. If you are watching this on YouTube, please do give this video a like and subscribe to the channel. Also, if you're listening on your preferred podcast platform, please subscribe there as well. We release a new episode every Sunday evening at 6 p.m. SA time. That's it from me, David Ansara. Until next week, take care.